Benign inflation, strong jobs growth, and overseas more record highs for stock markets. All pretty good news. But in this edition, we'll also take a look at our Reserve Bank's latest thoughts on record levels of household debt. The Consumer Price Index read this week was lower than expected, 1.8% headline CPI and the same rate for core inflation, so below the Reserve Bank's target band of 2 to 3%, which seemed to disappoint the market, pushing swap rates and the Aussie dollar lower. And this is one of the reasons we're actually more positive about the inflation data. A lower Aussie dollar is welcome news for the RBA, who have been vocal in saying that they would prefer it were closer to 70 than 80 cents. And secondly, low inflation means the Reserve Bank can take more time in moving away from these record low interest rates. We disagree with the view that this brings rate cuts back into play, but when considering the path back to neutral official interest rates, it's rising inflation or an overheated market that typically drives tightening cycles. And that's where the housing market becomes so important. The Reserve Bank's Financial Stability Review this month went into great detail explaining the risks of excessive household debt in the current property boom. But they did note that price growth has decelerated. As the chart shows, the massive jump in values in major capital cities has abated, especially for houses over apartments. Although the report also noted record levels of debt to disposable income. The RBA, however, expressed some comfort in the impact of macroprudential policy and noted that arrears rates and mortgage stress were comparatively low, and also compared our market to others overseas. So our experience isn't so different, it seems. And speaking of overseas, most offshore markets continue to be performing fairly strongly, with the US on track for their December rate hike after strong jobs and manufacturing data. Chinese data is strong, coinciding with their 5-yearly Party Congress, and Europe, despite the talk of Catalonian independence, also recording steady growth, especially in Germany. And finally, back home, our jobs market keeps powering ahead, with unemployment down to 5.5% and 20,000 net new jobs created in September, making it 45,000 full-time jobs added in the last 2 months. So all of this, together with a stock market back on the ascent, should keep a floor under business and consumer confidence for now, and an Aussie dollar well behaved in roughly a 75 to 80 cent band. As for household debt, this will become more problematic after rates rise, but the timing for our Reserve Bank appears to have been pushed back a little. Until next time, that's the market update from Bendigo Bank.